and welcome to Swissquote's Daily Market Talk. It's Wednesday, 19th of August. Rising Middle East tensions are pressuring oil prices and global bond yields higher these days, hence putting pressure on equity valuations around the globe. Technology stocks lead losses in the latest sell-off as sovereign yields make their return rates less attractive and sometimes not attractive at all. So I will dive into how expensive global technology stocks have become compared to each other and compared to lower risk assets. But before I do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
First things first, the main market driver since Monday this week is the rising Middle East tensions that pressure oil prices and global bond yields higher in expectation of rising inflationary pressures due to higher energy prices. And the latter is weighing on equity valuations across the globe. On Tuesday, for example, the US 10-year yield hit the highest level since January 2025, while a benchmark for the 10-year European bond yield rose to the highest level since 2011. Equities on both sides of the Atlantic Ocean hence pulled back, with the S&P 500 and Stoxx 600 indices declining around 0.70%, while Nasdaq 100 led losses with a 1.68% sell-off during the session, and VanEck's semiconductor ETF fell around 4%. This morning, Nikkei is following the Western peers lower, while the Korean Kospi index is down by more than 5% at the time I'm talking here this morning. Now, moving forward, the downside correction in equities will likely deepen if the geopolitical tensions remain tense. Energy companies' stocks remain a good hedge against the Middle East flare-up and energy price-led inflation risk. The cyclical and energy-dependent European indices, on the other hand, are, in theory, more sensitive to energy prices than the technology-heavy US peers. So an interesting question today is whether the technology-heavy US indices will outperform during this new wave of geopolitical jitters and heating energy prices or not. Now, judging by yesterday's activity, this is not yet the case because Nasdaq 100 index fell significantly more than the other major US and European peers yesterday, as I said. Yet, if the rise in oil prices persists and or accelerates, well, investors could eventually move funds toward the technology companies. This is what happened in the early weeks of the Iran war. The question is whether this could happen again. Well, possibly yes, but it's just that the big technology companies are increasingly vulnerable to global macroeconomic picture, more specifically to the interest rates, because the latest quarterly reports from the big technology companies show that their free cash flow levels evaporated due to the massive AI spending in the second quarter, and the latter leaves these companies more sensitive to borrowing costs as they will continue to spend big on AI infrastructure, but that spending will rely on debt. Now, this is not a new trend, but the latest second quarter reports from the big technology companies confirm this trend and show that the free cash flow levels were critically low and sometimes negative. And while the latter could maybe limit appetite when yields go up, as it is the case today, indeed, the big technologies corporate bond yields move parallel to the US long-term yield. When the US 10-year yield goes up, the US dollar-denominated bond yields with similar maturity follow. And while the latter applies a negative pressure on the valuations when these stocks are priced to perfection. Now, the good news is that perfection doesn't necessarily mean bubble. The bad news is it means expensive still. On the index level, as you doubt probably, the US equities 12-month forward PE ratios relative to past 2 decades now stand near the top of the historical range. And moreover, the US equities, both including and excluding the big technology companies, today occupy the top 2 positions in terms of how expensive these companies' stock prices have become. US equity indices are followed by Japan, Europe, and very down the line we find the EM stocks. The latter, so the EM stocks 12-month PE ratio stands below its historical ranges and only around 10.5 times versus the technology-heavy US indices 21.2 times ratio according to a recent chart by Goldman Sachs. So that means that yes, the US indices, the US technology indices especially, are expensive today, more expensive than the rest, and it makes sense to diversify geographically as high valuations make the major US equities earnings yield less attractive relative to cheaper markets where lower valuations leave more room obviously for multiple expansion and potentially offer a better risk reward profile. And that's not it. US equities have become less attractive compared to lower risk alternatives as bonds, for example, sovereign bonds. Nasdaq 100, for example, has a forward PE ratio of around 25, giving it an earnings yield of around 3.9%. That's well below the roughly 4.7% that you can get by allocating capital to the US 10-year paper, or around 5.30% yield that you can get from US 30-year bond. Just saying. That's one of the reasons why I don't think today that the US major indices have a big potential on the upside if the US longer-term yields keep climbing. The disrupted traffic in the Strait of Hormuz may be underpriced via crude oil prices today, but the US 10-year yields correlation with the number of ships that cross the Strait of Hormuz is remarkable. Of course, the transit data doesn't capture the entire situation in the Strait of Hormuz, as some ships reportedly go black to transit through the strait, yet the prolonged war in the Middle East also means pressure on inflation at some point in time via higher energy prices, when the Fed's policy outlook and its reaction function to inflation is no longer straightforward. The latter will continue to pressure the longer maturity US yields higher, then more military spending to keep this war going adds another layer. So something must give. Either the yields will come lower if Middle East tensions ease, for example, or stock valuations should readjust. But the global cross-asset picture today makes little sense in allocating more in US equities. What about other markets? Now, earlier this week, I have mentioned that the Chinese yields are diverging from the Western and Asian peers big time. China's struggle with property crisis, weak consumer metrics, and also the fierce price wars among the big technology and other companies are keeping the economy on the verge of deflation, and that's pulling yields lower in China. Lower yields, on the other hand, are supportive of the Chinese equity valuations, appetite being also boosted by the excitement around AI-related names, given the players are also grappling with higher AI costs on top of the destructive price wars that they are holding against each other and the fierce competition among domestic players. Well, looking in, Shanghai's technology-heavy Star 50 index, heavy in Chinese chips and AI hardware, rallied more than 80% since the beginning of this year and is up by more than 30% today, even after a sharp summer correction. But the Star 50's PE ratio today stands near 150 times, and it has an earnings yield of less than 1%, making it not cheap at all compared to Western peers, and not very appealing because the Chinese 10-year yield stands at 1.68% today. In comparison, the Hang Seng Index, which is heavy in China's big technology companies including Alibaba, Baidu, and Tencent, for example, has a PE ratio of around 12 times and an earnings yield of roughly 8%. Kospi, on the other hand, has a forward PE ratio of around 7 to 8 times, making it cheaper, though not less risky due to high volatility for investors looking for discounted tech valuations around the globe, with a forward earnings yield standing between 12 to 13 times, and that's well above South Korea's 10-year government bond that's yielding near 4.40% today. And elsewhere, the situation is better than the US. The Japanese Topix Index, for example, has a 5.9% earnings yield versus 2.90% for the 10-year JGB yield, whereas the TAIEX earnings yield stands at around 3.5% versus around 1.9% that Taiwan's 10-year government bond yields today, implying an equity yield premium of about 1.5 percentage points for the Taiwanese stocks. So when you look at this picture, what is clear that high volatility across technology valuations and leverage positions in the market today make the risk two-sided wherever you go and whatever price you pay for the technology stocks. But looking at the valuations and returns and comparing them with the lower risk government bond returns today, the Asian technology stocks, excluding mainland China's STAR 50, offer a better value for the risk taken by their investors than the expensive US and the mainland Chinese peers. So yes, it does make sense to diversify, even though it doesn't mean that you are going to be avoiding the high volatility in technology stocks which, when happens in tandem in all of these markets. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.